Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to do our normal, the first segment, going through the overview, understanding what is happening in terms of movements of crude and product around the world, but then, focusing in terms of what has happened in the U.S. so far. Segment 2 is going to go through demand, where is current supply, where's current demand in the U.S., and for those that watched us last week, we were expecting to see kind of that spike in terms of demand, especially on diesel. We had these two big down moves in diesel demand, distillate demand, that just didn't make much sense. And now we had that big spike back up. So again, now that things are starting to normalize, we think that will some of that noise is behind us at this point. And then in the segment 3, we're going to go abroad and look at global crude movements, as we do have more and more crude that is currently on the water, both in storage as well as in motion. So when we look at the overview of the data so far, the data came in fairly strong. We had nice draws across the board. Crude was driven by Pad 3, with the full draw was at 4.58 million, and then Pad 3, or the Gulf Coast, was 3.8. So as we've been saying, you're going to see Pad 3 continue to push liquids outside of their grouping, and it all comes down to taxes. So this is very normal in terms of the movements for the Gulf Coast. And then when we look at gasoline had a small draw of 720,000 barrels. And then distillate had a nice draw of 2.85. That's the distillate side, is where we see the most strength. That's going to continue just based on the diesel demand going into commercial trucking. And then when you look at the heating side, that's where we're getting, some of the data is getting a little bit better, but we've had some heat waves that have come through that have really kind of offset some of that. So now when we look at the total oil and products, just giving this overview, here you can see that the weekly draw, was of about, when you look at the deficit widening in total, the deficit widened from 15.7 to 26.9. And when you look at what really caused that, as we've been saying, total crude stocks, land and floating, the surplus narrowed a touch from 8.6 million to 0.3. That's the one that we think is going to really hold constant as we go into the end of the year. And then when you look at total oil product stockpiles, you can see the deficit widened from 24.3 to 27.2. That's the one that we think is going to tighten up a little bit, especially when you look at the data that has since come out in terms of what's happened in Europe and in Singapore. So we will start to see some of that adjusting, but again, still being fairly stable, not too many swings up or down, but really kind of continuing as we go into the end of the year. European gasoline arrivals in the U.S. dropped to the lowest in 3 weeks, in the 7 days through December 9th. Gasoline arrivals fell to 160,000 barrels per day. That will reverse, and not a huge surge, but we will start to see more of these flows coming as the builds on the gasoline side, specifically in Europe, started to increase and will unlock more coming into the U.S. And then European diesel imports rose to 337,000 barrels a day. And that's where we see that being fairly consistent. We don't see a huge surge or drop off, because that gas oil is still in a fairly good spot when you're looking at Europe in terms of where some of these opportunities are. Now, when we look at land storage, here you can see land storage is still in a good position. Especially when you look at the deficit narrowed from 48.9 to 42.7. And it's not because we had a huge surge in storage. It's purely because the comps are getting easier, especially when you look at just where we normally are for 2015, 2019 range. And that average is just, and this is what we've been saying, that you're going to get kind of this grind sideways, which will make some of these comps a bit easier. Land storage west of Suez, deficit narrowed from 32.1 to 27.7, and that will continue. And it's going to be more because due to what's happening in Europe. You're going to see some of these shifts. Cushing had a build. We'll start to see some of these builds as Pad 3 again continues to push this crude into other areas. Land storage on the east of Suez, deficit narrowed from 16 to 14.8. That's the one that we think is going to see a much bigger reversal. but not so much on the Shandong side because we're seeing them really flatline. The refinery run rates have dropped. It's increased on the state-owned facility side, but when you look at the Shandong side, you've actually had a fairly steady drop-off. We'll cover that more in segment 3. But that's going to put, keep things a little flat in terms of east of Suez, but you'll start to see some of that creep higher, especially due to Japan. But now when we look at floating storage, this is where we see some of the excess increasing. So when we look at the total, the surplus widened from 22.4 to 24.4. We expect that to continue to widen, especially when you look at east of Suez. West of Suez, the flip to deficit went from a plus of 4.4 to a decline of 6.8. That's going to be managed specifically. We've had some cargoes that have left Europe that are now going into Asia. Because of what Saudi Arabia did with increasing their OSPs, we're seeing Asian buyers essentially just keep reduce the amount they're buying from Saudi Arabia, which is increasing purchases both from West Africa as well as from Europe. So that will decrease some of that floating storage, especially west of Suez, and that's really looking at Europe and West Africa. U.S. Gulf Coast is going to waffle back and forth, but again, this is going to be how PADD 3 tries to manage what's in storage. East of Suez is where we see the biggest increase, and as we said last week, we did get it. The surplus went from 21.7 to 37.3. We see that increasing, and when you look back through even 2020, it's now above where we were in 2020, and it's going to continue to grind higher as these cargoes show up because we do have a lot of crude in motion, and a large part of that is aiming the east of Suez. Now, when we look at driving data, as we were saying in China, things dropped off and then really went sideways. We expect that to be the case. Ningbo had another outbreak. That will be a problem when we're looking at some of the economics. And then when you just look at driving information from North America or the Americas, things have gotten a bit better, but flat lines for the most part. Rest of Asia, something similar, as Europe just kind of grinds a bit lower. But again, we still think it'll be above average, but it'll just move a bit closer to the 100 line. Google mobility data is showing something similar. We had that a pop after in the Americas following Thanksgiving and some of that, but it's just not really back fully to normal, and we don't think it'll go fully back. Because of Omicron, people are just, or I should say COVID cases increasing in general, people are just limiting their exposures by who's going to the office, how often are people working from home, and the Apple mobility data is showing some of that decline as well. But again, still fairly stable. We don't see too many movements up or down. Now, this is just breaking down the crude stocks draw. So we had a draw of 4.58 million. Brings us 52.8 million below the 5-year average. But as we said before, most of that was driven by PADD 3, which had a drop of 3.8. That brings us, so PADD 3 is only 4.9 million below the 5-year average. But when we look at the average in general, it's still above 2019, and we think it's going to pair fairly closely to where we were in 2019. PADD 2 had a small draw of 760,000, but Cushing had a build of 1.29 million. We expect the Cushing builds, as we've been saying, to remain elevated, to be over that million barrel mark as more crude is left in there, and we have crude production at 11.7 million. We don't see that changing into year end. We think that that's going to how we close out the year. But then when we look at East Coast had a small build of 70,000. West Coast small draw of 300,000. Everything is fairly stable. It was just really that PADD 3. Now, when we look at the SPR, we had a drop of a total drop, including commercial stock, to 6.53 million. So we had about another 2 million draw that came out of SPR and into the global market, and that's something that will continue as people opt on if they're going to take the SPR release or if they're going to leave it. So far, the uptake has been fairly slow. And we really don't see that changing into year end. Now, when we shift over and we look at runs, so as we were saying before, we expected to see a little bit of an increase to about 90%. Instead, we held firm at 89.8. So again, it's just going to be that slow grind up. We typically have a little bit of a pause, one last push before, and then we have a drop for Christmas, and then we have that recovery going into January. So we do think we get just over 90% utilization rate. And you can see that there were additions to subtractions. So pad 5 had the biggest drop of 115,000 barrels a day. We think some of that comes back. And again, pad 3 is going to have a slow grind up as everything else stays fairly stable, which is going to be that, let's call it another 40 basis points of activity coming to pass, but still right in line with the 5-year average. Now, when we look at imports dropped 28,000 barrels a day. Pad 1 had a big spike up of 334,000 barrels a day. Everyone else was fairly flat, except Pad 5, which had the big drop of 204,000. Again, that is going to be more along the lines of timing. How quickly can they get back into the market? How can they import? Where is that delay going to be? So again, the pad 5 is going to be some of the unknowns, but that we do expect some of that increase. And then pad 3, we do expect to see that have a steady increase throughout. With pad 5, with the 5-year average, when you look at pad 3, is down 974,000 barrels a day. And as we said last week with pad 2, we expected a small drop, but it to still be well above the 5-year average. And that's going to continue just based on where the spreads are coming out of Canada. There is some repair going into the global market on the export side in Canada. But again, we still are going to see a lot of this coming down into the U.S. and remain fairly strong. So that's why pad 2 will remain that bright spot. Now, when we look at implied demand, here's what we were saying last week. We expected to get a bump in gasoline. Instead we got a much bigger bump than what we were expecting of 509,000 barrels a day. But when you look at distillate, so we said, and so I apologize, my lips are so chapped because I was on a plane, because obviously everything is delayed for about 12 hours, and it's just wearing that mask is brutal for that long. So distillate had an increase of 1.3 million barrels a day in demand. And this was after 2 very big down days in terms of demand, where we were saying it should be much closer to about 4.2. Not 3.5. So instead we had this huge spike up to 4.9. That will obviously drop. And then jet fuel, again, we thought 1.2 was too low. We were expecting a move back to about 1.4, 1.5, and instead it came into 1.6, again, trying to make up for some of that drop. That will normalize. Propane had a nice pop of 445,000 barrels a day. Went from 1.6 to 2 million. We expect that to pare back a bit, but again, you're starting to see some of the strength. But this is that last push. Now we see some of this bigger drop off, and then that will persist as we go into the winter months, into the Christmas week. So then when we look at pad 3, crude oil inventory excluding SPR, here you can see that things have come down a bit. Still, we just expect that the commercial inventories will be fairly flat. Obviously, things are going to waffle up and down, but we expect this to be fairly flattish as we go into year end. When you look at 2018, there was a slow decline. When you look at 2019, everything was pretty stable until we had that bigger drop off. And then when you look at 2017, there was a steady move down into year end. We expect this to have a similar trajectory in terms of small declines, because we are in December. There are normally draws from on the crude side, but it's just the pace is going to be fairly slow, and we expect to close out right around this level as we go into year end. Now, when we look at days of supply, because refining has slowed down, we're just above where we were in 2015, which is obviously below where we were in 2016 and 2020. But essentially, this is the third most crude, and when you look at days of supply that we have available, and even though crude storage looks low, it's really because refinery throughput still remains the underlying, because even though we are still fairly slow on the refining side. And this is, again, just averaging out. So that's where we do expect the days of supply to remain fairly flat, because you can see here you get these declines and then you flatline into year end. And that flatline into year end is just going to be is going to be due to imports, storage trying to get balanced out, and refiners trying to manage to not put too many liquids, especially in PADD 3. So then when we look at the total commercial oil storage, so there and products, here you can see that there was, again, putting it all together, there was a little bit of a drop, but again, we're still above the low that we had in November. It's just here, we expect this just to go sideways. Again, small crude draws, steadier, I think, builds on the product side. And typically we have a little bit of a drop, when you look at gasoline and diesel, there's a little bit of a drop in storage. And then, it's usually actually either this week or next week, and then you have those builds that accelerate into year end. So again, nothing too crazy, especially when we're looking at it against the seasonal norm. And this is what we're talking about here when you look at gasoline. When you look at what happened in 2016, when you look at what happened in 2017, in 2018, you kind of get this pause, and you get these small declines, and then you get this little bit of an acceleration. The pace of slowdown can change. In some places it goes flat, it's a small decline. And again, so we just got what is seasonally normal, and we expect this to reaccelerate on the build side into year end. And right now, when you look, we're actually tracking pretty close to 2018. So when you look at 2018, there was another small draw and then an acceleration. We think that you just get a straight acceleration and not another small draw. Distillate still remains in the most bullish backdrop. You can see here that we're still above the low that we achieved at the middle of November. And we do expect to see builds go back up as we go into year end. Demand, and it all comes down to, when do people need to refill their heating oil? So the last few weeks, we've had fairly warm weather on the East Coast, but you still need to refill. You're still consuming it. So now I think you're going to see these builds re-accelerate as we go into year end, as most people are now saturated or filled on the heating oil side. Road diesel will remain the strong suit, but we do expect to see kind of that seasonal build. And when you look at 2019, we had something similar, 2017, where you kind of go sideways and then you have a big spike up. And we expect something to be very similar when we're looking at seasonality. Jet fuel, nice spot. We're a new seasonally adjusted all-time low on the storage side. And again, this is really just based on how much is being left in the disti pool, how much is being pulled out into the kerosene pool. And because jet fuel demand has been fairly flattish, they're trying to maximize the amount that is available in the distillate pool. So this is something that will reverse, but remain fairly close to the bottom of that cloud. Now, when we look at the curve, you can see that the curve has continued to flatten. We're now just above 70 on the front month, with everything else starting to flatline. But as we were saying, essentially since we started this whole thing, was that the back of the curve, or the middle of the curve, was really the better place to be. And the reason why is because the front month was doing foolish things. You were seeing some crazy moves. But if everyone is right in terms of, how bad the supply response is going to be in the future, the lack of investment, all of these supply-driven things, that isn't really going to come out in the front months. That's a middle of the curve type situation. You can see, just looking at what happened 3 months ago, what happened a month ago. That's where you've had this big spike back up in terms of the back end of the curve, going from 40, from 52 up to 60. That's where we think there's the opportunity in terms of where some of that can play out. It would be really in the middle and back end of the curve, because that's when you're going to start to see demand really starting to normalize to where it was previously, and then where that supply response will be. And that's really looking much closer at what OPEC can respond with. On the COVID side, not surprising to see some of the case counts going up. Again, we've seen it in Europe, we've seen it in the UK, obviously the US again. Worldwide level, we had an increase. Now we're essentially fixed and sitting at this level. Germany, things are cooling off a bit. Asia Pacific, again, fairly flat, with South Korea and Vietnam seeing those steady increases, but Japan, again, holding firm and remaining fairly low. It's winter. We expect this to go up. I know that a lot of people, in terms of in my kids' class and in the school in general, we're seeing some of these steady increases that we believe that will just remain the case, and we'll continue to see some of these case counts grinding up. We're not expecting a huge impact. I know a lot of places have reinstituted mask mandates. Again, it's just people may try to avoid excess travel, excess shopping, excess exposure just ahead of Christmas, which again is going to be result in some small declines in activity, but not huge declines. Just if I can go to the store one less time, then I will. And that's what we're starting to see play out. And we'll talk about that in segment 2. Pad 3, this is where we're coming right back into where we were in 2019. We expect this to be a mixture of 2019, 2018, and close out the year right where 2018 was. That's how we see this playing out, just based on where exports are. We're seeing some exports remaining elevated, as we've been discussing. We'll talk about that more in segment 3, but this is where we see it playing out and closing out very close to 2018 levels. Cushing, again, we expect this to continue to rally, closing close to where we were in 2019. And that's just because there's a lot of opportunity, a lot of spare capacity in Cushing after that drop off. So we'll see this come much closer to about, let's call it 36 million, 36.3 million, right around where 2019 is. I think that's where we close out Cushing for the year. Floating storage in the U.S. had a drop. We expect this to bounce back up. Again, it'll just be below the 5-year average, but just stay within the bottom of the cloud as we go into year end. Pad 3 imports back down. We expect this to spike back up, but still stay very low. It'll fall back within the bottom of that cloud, but again, still be fairly tight. Nothing close to where we were for the 5-year average. Pad 2 had a small drop. We were expecting a little bit of a bigger drop, but again, it'll just stay well above the 5-year average. And as we said last week, well above the top of the cloud, just because of line 3. There's just more capacity now, so we have to reset this to an upper level. So Pad 2 imports will remain elevated. Refinery utilization rates, when you look at it over the last 29 years, right in line. We expect this to, again, creep a bit higher, break 90 this week, and then stay just below 91% into Christmas, get that drop off, and then the spike back up, and really kind of peak at about 92%. And as we get into the second week of January. So that's what we have for you on this side on an aggregate. Now, in the next segment, we're going to go deeper into where is U.S. supply, where is U.S. demand, and then how is that going to play out as we look towards Christmas, the holidays, and then into Q1 of next year.